The foundation of wealthy tax planning was named by Edward McCaffery, a tax law professor at the University of Southern California. He coined the term buy, borrow, die in the early 2000s to describe how the ultra-wealthy avoid taxation entirely. Here's how it works. Step 1, buy. The wealthy purchase appreciating assets, stocks, real estate, private business equity. Crucially, you only pay tax when you sell. If you never sell, you never trigger a taxable event. Jeff Bezos has sold Amazon stock strategically, but his core position has compounded for nearly 30 years largely untouched. Step 2, borrow. Instead of selling assets to fund their lifestyle, the wealthy borrow against them. Larry Ellison, the founder of Oracle, has pledged over 64 million shares of Oracle stock as collateral for personal loans, according to SEC filings. Elon Musk pledged Tesla shares to secure billions in personal credit lines. Why? Because loans are not income. The IRS doesn't tax money you borrow. Current securities-based lending rates for ultra-high net worth clients at firms like Goldman Sachs and Morgan Stanley range from 2 to 5%. Compare that to the top federal income tax rate of 37%, plus state taxes, plus the 3.8% net investment income tax. A wealthy person borrowing at 4% versus paying 40+% in taxes saves enormous sums. Step 3, die. Here's the closer that makes the entire strategy work. When the wealthy person dies, their heirs inherit those assets at what's called a stepped-up basis. The cost basis resets to fair market value at death. All those decades of unrealized capital gains, vaporized for tax purposes. According to the Joint Committee on Taxation, the stepped-up basis loophole costs the federal government approximately $42 billion per year in lost revenue. This is where most middle-class earners make their biggest mistake. They view real estate as just another asset class. The wealthy view it as a tax shelter that pays them to own it. The mechanism is depreciation. The IRS allows you to deduct the cost of a residential rental property over 27.5 years and commercial real estate over 39 years. Here's the magic. The property doesn't actually lose value. In most markets, it appreciates. But the IRS lets you pretend it's depreciating, creating a paper loss that offsets your real income. Let me give you concrete numbers. You buy a $1 million rental property. Roughly $800,000 is the building, $200,000 is the land. Land doesn't depreciate, but the building does. 800,000 divided by 27.5 equals roughly $29,000 per year in depreciation deductions. If you're in the 37% federal bracket, that's nearly $11,000 in federal tax savings. Add cost segregation studies, which accelerate depreciation on components like flooring, fixtures, and landscaping, and your first-year deduction can balloon to over $200,000. Donald Trump famously used real estate losses to report a $1 billion loss in 1995, allowing him to legally pay zero federal income tax for at least 8 of the next 10 years, according to New York Times reporting. He wasn't cheating. He was using the code as written. The common mistake regular earners make? They focus on cash flow and ignore depreciation. A property that breaks even in cash flow can still generate massive tax savings, effectively paying you to own it through reduced tax liability on your other income. Real estate professionals, defined as those spending 750 hours or more per year in real estate activities, can use these losses against any income, including W-2 wages. This is the single largest legal tax shelter available to high earners in America. Now let's get practical. This strategy alone can save high earners $50,000 or more in lifetime taxes, and you can implement it this week. The Roth IRA is one of the most powerful tax-advantaged accounts ever created. You contribute after-tax dollars, and every dollar of growth is tax-free forever. Withdrawals in retirement, tax-free. No required minimum distributions. Pass it to your heirs, still tax-advantaged. The catch. In 2026, if you earn more than $165,000 single or $246,000 married, you can't contribute directly. The wealthy don't accept this. They use the backdoor Roth. Step 1. Open a traditional IRA. Step 2. Contribute the annual maximum $7,000 or $8,000 if you're 50 or older. This contribution is non-deductible because of your income. Step 3. Convert that traditional IRA to a Roth IRA. Because you contributed after-tax dollars and there's no growth yet, the conversion triggers minimal or zero tax. Step 4. Repeat every year. The Mega Backdoor Roth supercharges this. If your employer's 401k plan allows after-tax contributions and in-service rollovers, you can contribute up to $70,000 total in 2026, including employer match. After maxing your standard contribution, you make additional after-tax contributions and immediately roll them to your Roth IRA. PayPal, Microsoft, Amazon, and Google all offer plans that permit this maneuver. Peter Thiel turned a Roth IRA into a $5 billion tax-free account by purchasing PayPal founder shares at fractions of a penny inside a Roth IRA in 1999, according to ProPublica's reporting. The growth, every dollar, was tax-free. The actionable takeaway. Call your 401k administrator this week. Ask 2 questions. Does our plan allow after-tax contributions beyond the regular limit? And does it allow in-service rollovers or in-plan Roth conversions? If the answer is yes to both, you have access to one of the most powerful legal tax shelters in existence. Robert Smith is the founder of Vista Equity Partners and one of the wealthiest Black Americans in history, with a net worth estimated at $9.4 billion. His tax strategy became public knowledge in 2020 when he entered a non-prosecution agreement with the Department of Justice and paid $139 million in back taxes and penalties. But Smith's legal tax planning, before any controversy, is the textbook case study. Vista Equity Partners is structured as a private equity fund. Smith and his partners receive what's called carried interest, the share of fund profits paid to general partners. Under current tax law, carried interest is taxed as long-term capital gains at 20%, plus the 3.8% net investment income tax, totaling 23.8%. Compare that to the top ordinary income rate of 37%. On $100 million of compensation, that's a savings of over $13 million per year. But Smith went further. He utilized charitable remainder trusts, a strategy where you donate appreciated assets to a trust, receive an immediate income tax deduction based on the present value of the future charitable gift, and the trust pays you income for life or a term of years. The assets grow tax-deferred inside the trust. He also used Opportunity Zone investments, created by the 2017 Tax Cuts and Jobs Act. By rolling capital gains into qualified Opportunity Zone funds, he deferred taxation on those gains until 2026 and could potentially eliminate taxes entirely on Opportunity Zone gains held for 10 years. The composite strategy, carried interest, charitable trusts, and opportunity zones allowed Smith to legally minimize his tax burden on hundreds of millions in income. While most viewers won't have access to carried interest treatment, the principles translate. Long-term capital gains over short-term income, charitable structures over outright donations, tax-deferred growth over taxable accounts. Stack these strategies and the savings compound. CTA 1213 Min. If you found this breakdown valuable, hit that subscribe button. WealthLogic publishes deep-dive financial intelligence twice daily, the kind of content that wealthy Americans pay financial advisors thousands of dollars to learn. Every video brings you one step closer to building real generational wealth. Subscribe now and ring the notification bell so you don't miss tomorrow's breakdown on the 3 retirement accounts that legally let you withdraw funds before age 59.5 without penalty. Outro 1315 Min. Here's the truth nobody tells you about wealth in America. The tax code is not a punishment. It's an instruction manual. Every deduction, every loophole, every preferential rate exists because lawmakers wrote it that way to incentivize specific behaviors: owning businesses, investing in real estate, holding assets long-term, deploying capital into designated zones. Working a W-2 job and saving in a regular brokerage account is the most heavily taxed path in the entire system. The wealthy don't pay less tax because they're cheating. They pay less tax because they've structured their financial lives around the code, not against it. You don't need $1 billion to start. You need to open a Roth IRA this month. You need to investigate whether your 401k offers after-tax contributions. You need to consider whether your next investment should be a rental property held inside an LLC. You need to learn the language of Section 1031 exchanges, qualified dividends, and stepped-up basis. The wealthy are not smarter than you. They are simply playing a different game with different rules. The rules are public. The strategies are legal. The only question is whether you'll keep paying the highest effective tax rate in America or whether you'll start playing the game the way it was actually designed to be played. Your wealth isn't built by what you earn. It's built by what you keep. Start keeping more today. The wealthiest Americans pay a true tax rate of less than 1%, while middle-class workers pay 14% or more. In this WealthLogic deep dive, we expose the 4 legal tax strategies that save high earners $50,000 or more every single year. From Jeff Bezos' zero tax years to Peter Thiel's $5 billion tax-free Roth IRA. These aren't theories. They're documented, IRS-approved methods used by the ultra-wealthy. Learn the buy, borrow, die framework popularized by USC tax law professor Edward McCaffery, the real estate depreciation goldmine that built Donald Trump's empire, the backdoor and mega backdoor Roth IRA playbook used by Silicon Valley executives, and the carried interest plus charitable trust strategy made famous by billionaire Robert Smith. Whether you earn $80,000 or $800,000, these principles can dramatically reduce your tax bill and accelerate your path to financial independence. Timestamps 0000, the shocking tax fact 00, 15 what you'll learn 00, 45 buy borrow, die explain 03, 00 real estate depreciation goldmine 06, 00 backdoor Roth IRA playbook 09, 00 Robert Smith case study 12, 00 subscribe for more 13, 00 the wealth mindset truth subscribe to WealthLogic for daily financial intelligence on investing, passive income, wealth building, and financial freedom. New videos every day at 8 a.m. and 2 p.m. Personal finance, wealth building, tax strategy, financial freedom, investing.